Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top business stories. Bloodbath on Dalal Street as Sensex Nifty closed at 11-month low on global rout. Market crash erodes nearly 7 lakh crores of investor wealth. All sectoral indices in the red. Food prices again drive retail inflation in May, though overall price rise eases to 7.04%. Vegetable and cooking oil prices rise in double digits. Inflation still remains significantly above the RBI comfort zone. Rupee hits a record low against the dollar as it reaches the 78 mark for the first time despite a late recovery. 10-year bond yield also spikes, crossing 7.6%. RBL Bank plummets over 20% to record low on appointment of new MD and CEO R. Subramania Kumar. Investors worry over asset quality fears. Most analysts downgraded the stock, noting that the appointment raised several questions. LIC plunges to a new low as lock-in for anchor investors ends, slips more than 5% to 670 rupees, down 28% on the issue price in just 20 trading days. Finance Ministry tries to downplay the fall, says LIC is a valuable asset and investor panic is distressing. Massive sell-off in the crypto market as series of news spooks investors. Ether down nearly 30%, losing its peg to the second largest cryptocurrency. Bitcoin at an 18-month low. Total crypto market cap dips under $1 trillion, down from nearly $3 trillion just 7 months ago. A complete rout on the Dalal Street with benchmarks closing at an 11-month low, eroding nearly 7 lakh crores of investor wealth in a single day. Investors witnessed Monday mayhem owing to red-hot U.S. inflation print released on Friday, which fueled fears of more aggressive interest rate hikes by the U.S. Fed Reserve. At close, the Sensex closed 1,457 points lower at 52,847, while the Nifty shut shop at 15,774, achingly close to 15,000. Down about 400 points for the day. Broader markets also in tune with the fall. All sectoral indices closing in the red, down 1 to 4%. Bajaj Finserv, Bajaj Finance, Tech Mahindra, Tata Motors, some of the top losers today. The rupee breached the 78 mark against the dollar for the first time, tracking the global risk-off mood and the strength of the US dollar. As the sell-off intensifies on Dalal Street, our global business editor Udayan Mukherjee spoke exclusively to Aditya Narain, MD and Head Research Institutional Equities at Edelweiss Securities, on the free fall in equity markets and his outlook going ahead.
Our guest on the show today is Aditya Narain, Managing Director and Head of Research Institutional Equity at Edelweiss. Aditya, very good to see you after a long time and thanks for joining in. Let me begin by asking you about the regime for the market right now. Do you belong to the camp which thinks that this is just a pullback in an otherwise bullish kind of cycle? Or do you believe that we are actually in the middle of a bear market, however long it turns out to be?
So, I wouldn't necessarily take either ends of it. But I do think it's not just a pullback. It's just not a market phenomenon, which is a pullback after a strong rally. I do believe that the economics have got stretched a little bit at this point in time, given what inflation has done. And so I would be watchful over the next couple of months to see the extent of damage that this inflationary run effectively does. And, inflation is one part. The other bit is the policy response that you get, which is a corollary of it. But the reality is that rates have gone up. There's been a certain amount of price intervention, and that tends to dislocate the mood a little bit. So, specifically to your question, is it a bear market or is it just a break? I'd say we have to sit back and watch a little bit. I think markets clearly continue to be at a little bit of risk, but to an equivalent amount, the economy also seems to be at a little bit of risk. So I think it's somewhere in between there.
Given the risks that you highlight, Aditya, do you think that it is possible? I mean, this is the question one keeps coming back to, because last 2 years we've got used to the market trading at valuation levels which are way above or quite a bit above the average multiples, the mean multiples that India has traditionally traded at. So given the new risks which have come to the fore, is it conceivable that we go back to trading at if not lower, then at least the mean multiples of the last 10 or 20 years? Because that too in itself would entail a 10-15% correction from even current levels.
Yeah, so I'd look at it in two frameworks. One, is it possible in terms of us getting back to lower levels of lower average multiples? Yes. I think the other element which is important to look at is whether fundamentally our premium or our valuation framework relative to other emerging markets, whether that's pushed up a little bit. And I'd say on the latter bit, I do believe a little bit of that has happened simply because there has been a little bit of a breakdown, not necessarily economics, but there has been a little bit of a breakdown in other key emerging markets, right? So in a relative context, India is probably a little better placed than it was vis-a-vis other emerging markets at this point in time. But at an absolute level, you're absolutely right. You do have risks in terms of multiples coming off a little bit. Now, what I do believe is that, one out of two risks will play out. Either economic slows a little bit, earnings slows a little bit, and so, the market comes off on the back of that, or multiples come off. I'd be surprised if you get a combination of multiples contracting and earnings contracting. I wouldn't play for that scenario, which is obviously very negative from here. I'd say you're probably still a little bit somewhere in between. But what has structurally changed is that within the EM basket, you are at actually more of an operating premium than you have been. From an economic trajectory perspective, you've not seen inflation like this for a fairly long period of time. And I think the damage it could do is still something that needs to be watched for, rather than glossed over as could be the case in a bunch of bullish camps.
There's an interesting point, Aditya, because it leads me to my next question, which is the kind of earnings disappointment we could be staring at. Last 2 years, we've only seen earnings upgrades from brokerages like you. But now, given what is going on in the world of commodities, which was a big contributor to these earnings upgrades, is it possible that we now begin to see earnings cuts coming in over the next few quarters, which is something the market had not seen for the last couple of years?
Yeah, so simplistically, yes. If you see our numbers in the recent quarter that reported, that's resulted in a net cut of about 2%. But it's as like you were saying, it's been hugely supported by commodities. If you were to strip out the commodity support, that number is actually much, much deeper. So to start with, you're absolutely right. I think the risks of downgrades at the aggregate level is actually reasonably high. At the broad level also is high, simply because you had a couple of standouts at this point in time. So I think that's one element of it. And that's why you're seeing, the market might be up a little bit in the recent past, but there is a certain amount of caginess or wariness in the market as it exists at this point in time. That's one element. I think the other element of earnings has been that what has been where people have, X of the commodity and the banks, right, which run a different cycle, right? But X of that, I think a lot of caution has been in terms of earnings getting cut because of margins, right? And you've seen some of that play through. But I actually believe the bigger risk and the less stated risk is what you could see in terms of demand being a little weaker. And I would suspect that would be the surprise element in terms of earnings downgrades if there were to be significant downgrades, rather than the shock of commodities and prices, which has generally been tending to play through.
One question about what you're hearing from companies, Aditya, because it's such a strange time. Globally, there is so much volatility. There is uncertainty about whether the world is heading towards close to recession, if not a full-fledged recession. And we are talking about a capex cycle fleshing out in the middle of this kind of uncertainty. Do you hear from companies a lot of confidence that they want to go ahead with capex planned earlier, or could it be a time of introspection or reassessment or being wary as well?
So let me put it this way. I don't think there has been a massive bottom-up capex build or expectation pull-out over the last couple of quarters, pre all these issues in any case, right? I think what you were tending to see was a confident and a measured approach where people were talking about brownfields, maybe the odd greenfields, but I think there were very, very few people who were really going overboard or overtly excited, right? In that context, I don't think too much has changed, right? Because there were specific plans, there were nearer term plans, and none of them were very aggressive plans. So I think a lot of that remains on board to start with, right? Secondly, I think a lot of the recession talk that all of us are a part of, it's more a market commentary, right, and a market expectation rather than anything that businesses on the ground are seeing, right? Whether it is the commodities players, whether it is the technology companies. So to some extent, I think as commentators, we get a little carried away. The market tends to look at it very seriously. But I don't think that sense has percolated down to businesses. That said, when you're facing the specter of such commentary, I think the capacity and the willingness of businesses to commit to stuff which is, not underway or very specifically on the drawing board, I think that capacity is limited. So I'd be surprised over the next couple of quarters, you see announcements of people talking about capacities in 2025 and 2028. So I think it's going to be what is in your books or what is on the drawing board. I think that continues. Let me be clear. I don't think it's a space where anyone has talked about pulling back on anything that is specifically on the anvil, right? It's just that looking beyond, I suspect there's a certain amount of caution that is coming through, but it is quite honestly very market driven. I mean, you haven't seen any data that suggests the US is in recession. So it's as I said, market commentary, which is where people are wary, and so stuff that's not on the drawing board will not come on, but that stuff that's on the drawing board will stay on. Is how I see it at this point in time.
RBL Bank today slumped over 20% to a record low after the appointment of R. Subramania Kumar as Managing Director and CEO for a period of 3 years. The appointment comes after former MD and CEO Vishwavir Ahuja unexpectedly stepped down. Most analysts downgraded the stock, noting that the appointment raised several questions. In his last role, Subramania Kumar served as Administrator of Dewan Housing Financial. He also served as the MD and CEO of Indian Overseas Bank. IPL has become a brand that everyone wants to get associated with, and the already richest cricket league in the world has only become richer. Over 44,000 crores is what the BCCI has already made through the e-auction of the IPL media rights, and expects that number to go up further with 2 more packages up for grabs. Here's the full report.
Well, it's been a big bonanza for Indian Premier League. Media rights for IPL have set to witness a high level of bidding, crossing over rupees 44,000 crore on its day 2 of bidding for media rights for TV broadcast and for digital for the IPL matches. In fact, at this rate, it nearly looks like each ball is being sold for rupees 50 lakh rupees. Now, through this, clearly it's understood that IPL now is not only the richest and the biggest sporting event counted in India, but it's also climbed up the ladder on the world sporting events list. In fact, it's considered now to be the world's 2nd largest sporting event. This is also directly going to push more and more ad revenues for IPL, where analysts expect that brands will be now flocking with more and more advertisements during IPL broadcast. This is the size and scale of the auction that has been witnessed. Now, who are the winners? Well, there have been a couple of names coming out, but we must wait for a formal and official announcement by BCCI, which shall be soon on the winning bidders for the 4 packages of media rights for Indian Premier League.
Food prices have again powered retail inflation in May. Though the overall consumer inflation moderated to 7.04% from the 8-year high of 7.79% in April, the increase in vegetable and cooking oil prices remained the biggest factor in overall inflation. Both remained in double digits. The overall food inflation also eased marginally to 7.97% from 8.31% in April. Despite the fall, inflation remains much above the 6% comfort level of the RBI. In fact, the RBI had last week forecast inflation above 6% for the first 3 quarters of this financial year. We're joined by Sunil Sinha, Director and Principal Economist at India Ratings. Sunil, thanks so much for joining us. Take us through what you're making or how you're interpreting the latest numbers. Just a marginal moderation, still uncomfortably high.
Yes, it is still out of the comfort zone of RBI. So while one may feel a little better when one sees the number dropping from 7.79% to 7%, but in effect, it is still on the higher side, and our expectation is that from June onwards, as the base effect starts waning till about October, November, the inflation will remain on the higher side. I mean, despite the fact that some comfort one can draw from the fact that the excise duty cut on petrol and diesel prices, though not reflected in the May number, will start reflecting from June onwards.
Okay. So, this time around we've seen, of course, vegetable prices really being the major contributor. What are you most worried about, Sunil, going forward? Is it going to be continued supply side concerns? Is it going to be those crude prices that continue to spiral? Because we're seeing this now as a global conversation. We've seen how markets have been reacting to the kind of pressure we're seeing on the back of these inflation figures.
So far as geopolitical situation at the global stage is concerned, I don't think that there is any clarity about that. So the volatility, uncertainty, all of these will continue to play out, and it simply means that the pressure on commodity prices are unlikely to ease, and India being a net commodity exporter, we will have to, go along. The only way some comfort can be provided to the Indian population is through the customs duty. And in case of petrol and diesel, the government has already done that. Some bit of it has also been done in case of, edible oil. And at the same time, some restriction on wheat exports and some of the other commodities. So net, the situation is that, there is very little that India can really do about what's happening on the global stage. I mean, that's something which is given. However, the positive aspect of looking forward is that the monsoon is expected to be normal this fiscal. And if it plays out according to the Met Department's prediction, then some of the food pressures that we are witnessing right now may somewhat ease. Not so much on the edible oil, but certainly on cereals and pulses and so on and so forth. And also the vegetables.
All right, Sunil, thank you so much for joining us and taking us through the latest implications of those spiraling inflation numbers. Now, the pain of rising prices will continue to pinch in the weeks ahead, with the rupee sliding into uncharted territory and crude oil spiking above $120 levels, even as the government keeps fuel prices and the resulting price rise in check.
All has been relatively quiet on the fuel prices front for the past 68 days. Despite the heat, retail prices have not increased. In fact, falling in mid-May when the Sensex states cut excise duty and the value-added tax on fuel. In the national capital, petrol prices remained stable for a month and a half before falling to the present level of 96.72 rupees per litre. This despite the price of Brent crude rising from $74.89 per barrel on the 6th of April to $120 at present, a rise of more than $45 a barrel. Meanwhile, it's the other fuel products which have faced the price shock. CNG price in the national capital has risen to 74% since April. Non-subsidized LPG prices have risen 6%, while aviation fuel prices have zoomed to 30%. The price freeze is reportedly eroding the bottom lines of oil marketing companies. According to sources, these companies are absorbing losses of 18 to 21 rupees on every litre of fuel sold in the market. What is complicating the matters is the strengthening of dollar against the rupee. The Indian currency has breached the 78 to a dollar level in trade today, closing at 78.13 to a dollar. This basically translates into the fact that every barrel of crude oil coming into India is 5% costlier than it was in January, just because of the rupee-dollar exchange rate. This is a triple whammy for a government which is battling 8-year high inflation levels. Not only is it subsidizing sale of fuel, it is also facing national losses due to the excise cut of fuel. Now, with both the dollar and crude prices working in tandem against it, the government may soon have no choice but to lift the price freeze. A poll by Business Today shows nearly 80% of the respondents are in favor of the price freeze. However, comments by several respondents show how the common man is worried about the economic cost of the price freeze as well. Clearly, there is a growing realization that if not directly, the Aam Aadmi is indirectly paying for the cost of increased prices in other ways. Bureau Report, Business Today Television.
India has continued with its tough stance at the 4-day WTO ministerial conference in Geneva. The 164 member countries discussed the issue of multilateral trading systems on Sunday. Today, 2 sessions were slotted, the first on WTO's response to the COVID pandemic and the other on food security. India's Sherpa to the conference, Commerce Minister Piyush Goyal, forcefully set the agenda.
The pandemic reinforced the importance of one earth, one health, calling for global solidarity and collective action. My country ramped up supplies of medical products to provide medical and health items globally. Unfortunately, the WTO could not respond with alacrity. We have let down the people of the less developed countries and developing countries. The rich countries need to introspect. We need to bow our heads in shame for our inability to respond to the pandemic in time.
That's all we could pack into this edition of Business Today. Bye for now.